And so over the next 15 minutes, I'm going to give you a very brief rundown on the federal budget changes, or rather those federal budget changes that have been legislated. And so 4 big changes that have recently been legislated, as you may have heard, is that there's going to be a ban on limited recourse borrowing arrangements on residential property. There's going to be changes to the negative gearing regime. There'll be a 30% minimum tax on capital gains accrued post 1 July 2027, and there's going to be the removal of the 12-month 50% discount on gains accrued post 1 July 2027. Let's have a quick look at the ban on residential property limited recourse borrowing arrangements. So you can still use an LRBA to purchase property, real property, but if you do purchase real property, it must satisfy the business real property definition. What's that? Well, that property must be wholly and exclusively used in a business for it to meet the definition of business real property. You cannot enter into a limited recourse borrowing arrangement from the 10th of August 2026 to buy residential property. Now, there is, of course, grandfathering. If you've already entered into an arrangement to acquire residential property prior to 10th of August, they'll be grandfathered. And, of course, any refinancing of loans post that time on arrangements entered into prior to that time will be grandfathered as well, or allowable. Let's move on to the negative gearing changes. So investment properties, and this only relates to investment properties, bought after 7:30 p.m. on the 12th of May 2026. Well, any losses on those investment properties will be quarantined from 1 July 2027. So you can still negatively gear up until 1 July 2027. There is grandfathering on properties purchased before 7:30 p.m. on the 12th of May 2027. But for those properties that are not grandfathered, the losses are not lost, but rather the losses are quarantined. So what does that mean? Well, that means if your losses on a property, investment property, exceed the income from that property, then you get to quarantine the loss until a later financial year when that investment property actually produces more income than the expenses. In addition, you'll be able to use those quarantined losses against any capital gain on residential property. Now, keep in mind, there are exclusions. So for new residential builds, they will be subject to the current rules, i.e. you can still negatively gear on new residential builds. Now for the big one, the CGT changes. So you're going to have clients sitting into probably all of these 3 buckets. They may hold investments today, which they purchased before 1 July 2027, and they might dispose of those investments before 1 July 2027. Well, no changes in that scenario. You might have clients who have bought assets before 1 July 2027 and continue to hold those assets beyond that time and don't dispose of them until a later date. In that scenario, those gains accrued up until 1 July 2027 will enjoy the 50% discount. Any gains accrued post that time will be subject to the indexation method. So in other words, the cost base will be indexed and you'll only be taxed on the real gain. And unfortunately, there'll be a minimum 30% tax on any gain accrued post 1 July 2027. Now, of course, for assets bought and sold post 1 July 2027, the new rules apply. So indexation and the minimum 30% tax. Let's have a look at the 30% minimum tax. How's it calculated? Well, it's fairly straightforward. It's simply 30% multiplied by the assessable gain will be the minimum tax, So for example, we've realised a gain for $50,000. The minimum tax on that would be 30% on $50,000. But again, being the minimum, we'd need to compare that to how that additional income, how that additional assessable gain would be taxed at marginal rates had it just been added to the individual's assessable income. And so if that would have been taxed more than, in this instance, 30% or $15,000 on that $50,000 gain, then the higher tax rate would apply. Now, there are exclusions, again, new residential bills and individuals who are in receipt of certain income support payments, such as the age pension, job seeker. I think paid parental leave is even one of those. Government-funded paid parental leave, that is also one of those exclusions. So one thing to think about, if you've got a client who's on the cusp of getting an age pension, there might be an incentive to put in strategies there to help them get at least one fortnight of age pension in the year in which they're going to realise a gain in order not to be subject to that minimum 30% tax. Now, one of the things that is a bit of a bummer for advice is that personal deductible super contributions will not reduce the minimum 30% tax. So for example, we've got realised a gain of $50,000, we make a personal deductible contribution of $20,000. Well, our minimum tax is still going to be 30% on the $50,000. It's not going to be 30% on $30,000 because in theory, we've reduced the assessable gain with that personal deductible contribution. So no, personal deductible contributions will not reduce this minimum 30% tax, although it can still be helpful. So for instance, we've realised a really large capital gain that puts us into a very high, on the top tax bracket, then yes, still making personal deductible super contributions can still help. It can bring us down to the minimum 30% tax, but it's not going to take us below that. Now, charitable donations, they can reduce the minimum, the tax on these gains. Now for the, I guess, the more technical side of things. So where we've got a client who has held an investment before 1 July 2027, and they still hold it after that date. Well, in that scenario, there's going to be what we call a deemed disposal as at 30 June 2027. Okay, the deemed disposal. And so there's going to be two components now on this asset. There's going to be a pre and a post component. Let's look at a scenario here, explain it. So let's just say hypothetically we've purchased an asset for $100. Its cost base $100, but then it drops in value to $50. Well, now there's going to be a deemed disposal. Sorry, go back there. So it drops to $50 and then jumps back up to $200 and we sell it for that price. Okay. So in that scenario, there's been a deemed disposal at 30 June 2027 for $50. And we've repurchased that same asset for that amount as at 1 July 2027. So we have two components here now when we eventually sell. We've got a loss of $50 and then we have a gain of $150 based on the new cost base. Now that new cost base is at 30 June 2027, 1 July in this instance, 1 July 2027, will be indexed. So that cost base won't be $50, it might be, say, $53. We'd take that cost base from the proceeds of $200, which would give us a gain of $147. Now, we've had a loss in the previous period of $50, and we'd take that loss off that $147 gain, which would make the assessable gain $97. Now, keep in mind, it was remiss of me to mention, in that scenario, I used the market value. The market value as at 30 June 2027, but the Minister is yet to release an instrument that will give us an indication as to a formula that we can use instead of the market value as at 30 June 2027. Anyway, here we've got another scenario. In this instance, the asset is purchased for $100, goes up to $150 as at 30 June 2027, and then continues on its merry way to $200. So in that scenario, we've got an assessable gain. We've got a gain in the first period of $50. Only $25 is going to be assessable. Why? Because we've got the 50% discount on that amount. And we've got a gain of $50 in the second period. And after applying indexation, only $41 is assessable. So we'd add the gains on both components, and that would give us a total assessable gain of $66. And so we've got to compare those two scenarios. So in the first scenario, we didn't have any gain in the first period, i.e. there was that $50 loss, and all the gain was attributed to the second period when indexation applies. And that did not give us a good outcome. Why? Because we'd rather have the 50% discount rather than indexation. So when we compare that to the other scenario where we've got a $50 gain in the pre-component and a $50 gain in the post-component, you'll see that the assessable gain is less, $66 versus $97. So in this scenario, what we might be thinking about is, well, should we be using the market value method as at 30 June in determining the value as at that point in time? But why? Because we want the gain to be as big as possible at 30 June 2027, because that growth up until that point in time will enjoy the 50% discount versus the growth post that period that will be subject to indexation and also subject to that minimum 30% tax. Now, one final point I'll make is that only gains are indexed. So losses are just losses, where we don't index the cost base when we're looking at what is the calculated loss on an investment. So in this scenario, we've got the asset, or the investment's gone up from $100 to $150, then drops down to $100. So in that scenario, we offset the $50 gain on the first component with the $50 loss in the second component, and we have no assessable amount. But of course, in that scenario, unfortunately, the client's probably behind, because with inflation, they're actually backwards in real terms. So that's a bit of a brief rundown on the federal budget changes, a bit of a very high level, but now I might pass you on to Chris.
Great, thank you, Stu, and thank you everyone for having me here. So I should probably start this talk by saying that I've never been asked to give a talk about tax before. Unlike the last speaker, I'm not a tax expert. However, since the budget changes came out about 10 weeks ago, I've spent a lot of time analysing them, trying to understand them, and really trying to seek to see how they'll impact investment markets, investment portfolios, and other parts of my business, including all of my employees who are shareholders of our business. Look, I'm still not sure I'd call myself a tax expert, but I have spent a lot of time analysing this, and so I wanted to share some of the interesting insights I've discovered over the last 10 weeks, particularly the ones that I think relate to advice that advisors will now need to consider when they're giving advice to their clients going forward. Now, over the last 10 weeks, I've now written 8 articles that have been published in the Australian newspaper in the wealth section about these changes across a whole bunch of different aspects, including the impact on the economy, productivity, the share market, different types of investing. I don't have time to go through all of them today, but you can certainly go and find them afterwards, and I'm going to focus on just a few of those key changes. And yeah, as I mentioned, the ones that I think will really impact you all the most. Also, out of your interest, so when the Senate inquiry was being held for these CGT changes and the tax changes, I was very disappointed that they didn't bring along a broad spectrum of different opinions. It seemed like a very whitewashed process. So Jeff Wilson and I actually ran a shadow inquiry right next door. We had about 150 people turn out to share their views and opinions about these CGT changes. The turnout was much better, I must say, than the actual Senate inquiry. And we had some of the senators, including Andrew Bragg and others, come across into our inquiry instead. And so we have actually heard a lot of community opinions about these tax changes too. And just briefly about Stockspot. So Stockspot's an online investment advisor. We wouldn't usually at this sort of event because we don't typically service advisors. We have some advisors that use us for their smaller client portfolios, the ones that they don't want to service or are unaffordable to service. We basically build and manage ETF portfolios for retail clients. We have about 21,000 clients around Australia and manage about $1.5 billion, but we're typically a direct-to-consumer product rather than an advisor product. But yeah, it's something we have to think about because we've actually built the tax software for our ETF portfolio. So we intimately need to understand the tax consequences of these changes because we're actually going to be building the tax software that reflects them very soon as well. So Stuart's obviously already covered in a lot more detail than I am what the high-level changes are. So just to kind of cover them very briefly, there's going to be the return to cost-based indexation. Obviously in the media they've talked a lot about how this is what was the case pre-1999. Look, there are similarities. There are also quite a few differences. Back then you had the ability to spread your gains across multiple years, which has now been lost under this new legislation. There's also the 30% minimum, which certainly didn't didn't exist back then, so it was another big change. Stuart's also talked about limited recourse borrowing and the changes, particularly around that for self-managed super funds. And negative gearing as well. So these are the high-level changes. Yes, Stuart's already covered them in a lot more detail, so I'm not going to focus them on in my talk. Look, let's start where the reforms directly impact different investments and their attractiveness at a high level. So as probably a lot of you are aware, superannuation was broadly exempt from the CGT changes here, which makes superannuation relatively more attractive than investments held outside of superannuation going forward. Obviously, property and limited recourse borrowing, is a difference, but broadly speaking, the fact that income is taxed at 15% and long-term capital gains at 10%, certainly makes this a more attractive investment structure on a relative basis going forward. Direct investments outside of super, I'm going to spend most time on that today because I think it's the most interesting, and there's some real nuances and second-order consequences that I don't think Treasury really considered. In a broad sense, they're negatively impacted for those reasons that Stuart explained, the 30% minimum, and the fact that any asset or investment that's growing by more than 2 times inflation actually is going to be paying more tax under this new system than the old system. And again, I'll go into a bit more detail later. Then there's obviously the new residential property that becomes relatively more attractive because it retains, the tax advantages that they've had previously. The other interesting one, I think, is people's primary place of residence. Now, this is obviously something that the government didn't want to touch, a lot more politically sensitive than even capital gains tax. But I think the other interesting consequence here is people are going to be more motivated to put more money into their primary place of residence simply because it's one of the few completely tax-shielded investments out there and becomes relatively more attractive as well. So, you might see people looking to upgrade or renovate or do anything they can to actually increase the value of their primary residence because it's a tax-advantaged investment, and certainly compared to different investments now held outside of super becomes more attractive. Possibly not the intended consequences of the reform because property was, supposed to become more affordable under these changes. So that's just at a very high level. Now I wanted to go into a bit more detail, particularly around that second point around direct investments outside of super, because that's where I've spent the most time, thinking about and analysing. And this one, I think, is probably the most important and least understood parts of the reform, which is around how the indexation calculation is applied. So interestingly, this is something that didn't come out on budget night. In fact, it took over a week for this to sort of surface, and it was surfaced because an ex-Treasury official put it on X, on Twitter, and a few like myself picked it up and did a bit more analysis to validate that this is actually what's happening, and then we reached out to Treasury and they confirmed it as well. But in a very basic sense, in the past, if you have an investment in a portfolio that has a positive return and a negative return, they can help to offset each other in a nominal sense, and you pay tax based on the difference between the winners and the losers in your portfolio. Under this new system, you're now going to be paying more tax on the winners in your portfolio because you'll only have indexation as a shield and not the 50% discount. The problem is that for the losers in your portfolio, and Stuart touched on this in his talk as well, you're only actually able to use the nominal losses, not the real losses. And although that might sound technical, it actually has an enormous consequence for a portfolio of investments. And the reason for this is most portfolios that you own or your clients own or are held generally aren't only made up of winning investments. So by winning investments, I mean assets or investments that have positive real and nominal returns. Most portfolios are actually a basket of winners and losers. Hopefully you have more winners to offset the losers, and that's what gives you a positive overall return. If you look at the ASX 200, for instance, in any particular year, typically 35 to 40% of companies are actually going down in value, and 60% or so are going up. And there's great research globally, Bess and Binder in the US and JP Morgan, that have done wonderful research that shows that over much longer periods, like 100 years, it's about 6 or 7% of the entire share market that generates all of the returns and wealth, and the other 90+% that actually loses value. And this is why this is particularly important, because in the past, we've always told our clients that diversification is one of the few free lunches that you're afforded when you're investing. Unfortunately, these tax reforms actually penalise diversification if you're doing it on an individual share basis. And this is a worked example I've shared online, and you can find more detail on the Stockspot blog if you're interested, or I've posted it on X. I went and found the 20 most popular shares owned in ShareSite, one of the share tracking softwares out there, 5 years ago. So they write a blog every month talking about the 5 most traded shares, 20 most traded shares. I found them all, and I said, okay, imagine you were equally weighted a portfolio with those 20 popular shares and held them for 5 years. And I looked at what would the tax be under the old system and under the new system. And what was really interesting was, unlike what the government's sort of gone out there and said that it's actually much of a muchness for share market investors, what I found was that under the new system, the effective tax rate is significantly higher. It was actually higher by 82% on this example here, because the losers don't help you offset the winners, and there were quite a few losers in that portfolio, as well as a few big winners as well. And so, I think this really is the first key insight, which is that people can no longer afford to have losers in their portfolio because you don't get sufficient ability to offset them from a tax perspective. And it's something I think a lot of advisors really need to be thinking about now. And I'm going to talk about structure in a second. I know people hold these in different structures, but you certainly need a structure that allows you to offset winners and losers before it's considered from a tax and indexation perspective. Otherwise, the penalty is enormous. And I'm not the only person that's done this analysis. A former Treasury official by the name of Jeff Francis has also done some analysis in the AFR and published his views. His view is on average, the effective tax rate is going to be 65% for a typical portfolio of shares. And so, the consequences, I think, of this, and this is why one of the reasons I've been extremely critical about these reforms, is it's going to drastically transform share ownership in Australia. Because, what I grew up to do, and I think a lot of you as well, buying a few shares in a portfolio and learning about the share market in that way, it's no longer going to be appealing from a risk-adjusted perspective and an after-tax perspective, and people are going to need to think about new ways to invest. Ironically, Jeff Wilson and I, who have been out there, probably two of the most critical people about these reforms, our businesses, which are predominantly investing into ETFs, and his business LICs, are largely shielded from these, and actually these are two of the structures that I think will benefit from these changes. I'm going to talk about this shortly. But yeah, this is an interesting worked example, and it would be an interesting thing to do with your own client portfolios or own portfolios, is have a look at the actual tax consequences. I'll share a link later, but we've got a calculator on our website where you can put in the numbers and do your own calculations. But if you have any losers in your portfolio, the consequences are pretty rough, and you've got to be thinking about how you can aggregate holdings. And so tax is calculated on a pooled structure rather than an individual asset basis. So that's the first one. The second one, which leads on for the first one, is structure is going to be even more critical than it has been in the past. I know people here would be, the talk just before was on SMAs and MDAs, and I know there's lots of different structures that you can hold investments in, but I think structure is going to be an even more critical consideration for advisors, and certainly any investor into markets. Pooled structures, as I've explained just now, are going to become more attractive than owning assets individually, and this is going to become even more critical where you have wider dispersion of returns. The more dispersed your returns are, the bigger the tax consequences. So let's say a portfolio of risky mining shares where you have one enormous winner of lots of losers, horrible tax perspective, and I've found a few examples where you could be paying over 100% effective tax rate, which seems crazy, but it's possible. The same with venture capital or anything risky. It's less of a difference if you have more lower risk type investments, but direct shares, not attractive. Pooled structures more attractive, but there's big differences. So ETFs, not only are they a pooled structure, but they have two other advantages, which is one, they have relatively lower portfolio turnover if they are true indexed ETFs that are following the market. This is important now because you're going to be paying an effective 30% minimum tax on any capital gains, and trusts like ETFs or managed funds will have to distribute those capital gains, and then the end investor will be hit with a minimum 30% tax. And so the portfolio turnover of funds is going to become a more important consideration. allocation. ETFs also have another structural benefit, which is that they're able to stream capital gains out to market makers. And so when there are redemptions out of an ETF, typically ETFs are able to shield their underlying unit holders from some of those capital gains. So those are two of the ETF advantages that I think will become even more magnified under these changes. Managed funds have the benefit of the pooled structure. However, two considerations now are what's the portfolio turnover, because this now has a bigger tax consequence. Fund managers that have higher portfolio turnover, potentially will be driving not as beneficial after-tax outcomes for investors in those funds. And then there's also the lack of an ability to stream out of managed funds. This is particularly important for managed funds that are in a outflow or redemption phase. The problem is that if a managed fund is in outflows because their performance has been poor, for instance, when those redemptions are triggered, they have to sell the underlying investments. That triggers capital gains, and those capital gains are then distributed to the remaining unit holders. And so actually, there could be almost like a self-fulfilling prophecy now of funds that are having poor performance, because it's going to lead to a rush to the exits that is magnified by these tax consequences. So something to think about when it comes to managed funds, particularly fund managers where the performance hasn't been great and overall there's outflows. It's a new consideration you might not have thought about before, but outflows actually impacts the tax consequences of remaining unit holders. And then LICs also benefit from the pooled structure, and obviously they're in the company tax regime, so it's a whole different kettle of fish altogether. And they're generally a good structure, although there are some disadvantages as well. So I think that the main point here is you really have to consider not only what's within your portfolio now, but also the structure that it's held in. The last point I wanted to talk about is just around the substitution of income and capital growth. So obviously within a portfolio, there is the total returns made up of capital growth and distributions. And a lot of the education that advisors I know have been doing with consumers over many years is around the substitutability of these two, and that ultimately your total return's important. What I think is really interesting about these reforms, and hasn't been covered that much, I've written a couple of articles in the Oz about it, is just around the consequences for demands for dividends versus capital growth. And I've tried to illustrate in a very simple example here, so let me try and explain it. If a company earns $100 of earnings, and then after company tax rate it has $70 left to distribute, if that company then distributes it to someone who's also on the 30% tax rate, after franking credits are accounted for, that investor ends up with $70. However, under this new regime, if they reinvest that money into the company and it leads to $70 of capital growth, and that $70 of capital growth is then taken by an investor in that company, then the effective return that investor gets is less, because they are then also getting hit with the minimum 30% tax rate on the capital growth. Now, that's not precise, and there's certainly other variables that are at play behind the scenes. Companies are obviously looking to achieve a return on any investment they're making in their business. But at the margin, what I think this will do is actually lead to a preference for investors over franked dividends, over capital growth. And this could be quite transformative for the economy broadly, because if investors are demanding it, and we're already seeing in the last couple of months ETF demand in these areas has been really increasing, then boards are going to be under pressure to not reinvest into their businesses, not to reinvest into growth and looking at overseas opportunities, but actually just to distribute more of their income to shareholders. And I've said that this may lead to a bit of a productivity crisis in our country, because there's going to be no motivation for businesses to reinvest into AI and growth and other opportunities, because everyone's going to say, please just pay me fully franked dividends. Now, this may all change in next year's budget if the government realises this and also goes after franking credits. You can be certain that Jeff Wilson will be on top of that one if that happens again next year. But it shows that this actually creates a few interesting distortions. My time is almost up, so I won't spend too much time on this one. The main point is that the consequence of this is actually most felt at lower income investors. So if you've got retirees or younger clients who are on lower incomes, their preference is even stronger now for dividends over capital growth, which seems perverse because young people should be going for growth, but instead young people are going to be demanding dividends. So that's a bit of analysis there. I think the final point is that 3 questions I think every advisor needs to consider when it comes to their clients' needs now is, how are investments held? Are they held in super or are they held outside of super, and what are the consequences? How is it structured? Is it a pooled structure? Is it a LIC, a managed fund? And what are the tax consequences of that decision? And then what's the makeup of total returns and what's the tax consequences of that between capital growth and dividends? That's a very quick summary of a few of the interesting, I think, nuances and distortions that I think that this is actually going to cause, and some of the things I think you all need to think about when it comes to whether it's your platforms or your conversations with clients. Just one plug I wanted to give at the end. If you do want to do any of these calculations yourselves, I've built a calculator which is free on our website and you can use it as much as you want. We've had over 100,000 people come to the website and use it already. We had 30,000 on budget night because knowing that this might come, we actually built it a week before budget night. Give it a go. We've reflected all of the current legislation in there, so it should be accurate. The only thing we're not sure about is something that Stuart touched on, which is what methodology the government will use for transition. We've assumed it's going to be the KGAR method, but there's also the possibility of a time-based method. So we'll make that change once the legislative instrument comes out. Happy to answer any questions, as I'm sure Stu is as well on these changes.
Great, thanks Chris, thanks Stuart. We do have a few minutes for questions, and I think we've got a few of them.
My question relates to unregulated financial mechanisms, and the one they'll throw out there, which is pretty common these days, is, say, crypto. Is that still captured in the CGT? It is, okay.
Yeah, absolutely. I mean, cryptos, unfortunately, a lot of young people own it. It's very exposed because there's obviously no distributions. I mean, people can do staking and there's other ways of earning income, but generally the growth comes from capital growth. And I think the group I've certainly seen most furious online is all of those crypto holders that have owned Bitcoin or Ethereum for many years and are sitting on some gains and are now sort of facing the tax consequences of that. So,
Good question over here.
Two sessions we had before. So we had the MDA and SMA section, and then you had your section here on holding direct shares. So often many MDAs and SMAs will offer direct listed shares in their portfolio as part of both structures. Do we know how that's going to be affected? Like, is there something with the platforms that would there be any sort of pooling, or does the SMA or MDA with direct shares be badly affected versus investing in a bunch of funds instead?
Shall I answer that? Because I'll answer that. Well, I'll start off with the answer, which is I asked myself exactly the same question. Is there an SMA or MDA implication for this? And I thought, as far as I was able to establish, no, because actually both of those instruments, the underlying holder is the underlying holder, as opposed to the unitised structures that Chris and Stuart were talking about. But do you want to?
Yeah, I think it's best to talk to whichever providers you're using. I think it all comes down to how tax is calculated. If tax is calculated on an individual share basis, you're going to be faced with the consequences. I think maybe an innovation that some of the platforms should be considering is how they can actually unitize SMAs, which seems, I guess, counterintuitive. But I think the tax consequences, unfortunately, are so large here that I think people are going to be forced to think of ways. You want to be calculating your tax bill on an aggregated basis. There's just, from all the analysis I've done and others, there's just no way that you want to be calculating tax on an individual asset basis because the effective tax rate goes up so much. So,
Yep.
What do you think the chances are of there being amendments to this? Because it hasn't passed yet, has it?
I mean, I think the only amendments that could possibly come are from a future government. So it's passed. It's passed. It passed quite easily. There wasn't a lot of, I think, open debate around it. I put in submissions to the Senate inquiry. It wasn't published till actually almost after the Senate inquiry completed. And a few people that put in critical submissions have said the same. Analysing the submissions, about 90% were negative, but interestingly, almost all of the people that went to the Senate inquiry had a more favourable view towards it. But yeah, it's passed. It's going ahead. I think there's only a few variables that haven't been considered, and one Stuart and I were talking about is I think you were saying it's going to be a legislative instrument.
As you mentioned, that transition method where you're looking at what's the value as at 30 June. We know there's the market value that we're going to have to use and how do we calculate under the apportioning method. We just know it's an apportioning method. We haven't seen the formula.
Just on the apportionment method, so I wrote an article last week in The Australian just showing the importance of getting valuations on any unlisted assets or assets where there isn't a transparent valuation. This is another trap sort of hidden, which is if you don't get a valuation, the impact of using the default valuation methodology, regardless of which one it is, could be a lot worse than actually the valuation. And I showed 2 examples in the article showing how you could be paying, $500,000 more in tax for a startup investor, or $100,000 as a investment property owner. So it wasn't in the presentation, but something to consider for your clients is if they have any unlisted assets or assets that are harder to value, getting a credible valuation on June 30 next year or July 1 next year is going to be incredibly important to establish a valuation, because you ultimately want, from as you saw in Stuart's presentation, as much of your capital growth to have occurred before next year, because you want to enjoy the benefit of the grandfathering of the 50% discount. You want no gains to be happening after that, or very little, because the punitive tax consequences after.
I think we have one final question.
Oh, no pressure. It was interesting with the different structures that you had there. So clearly the super is the best environment to have your investments. And it seems like apart from a company, everything else is just going to be taxed like it was in your own hands, because a fund is going to distribute whatever it has and it's going to have the same issues. So I just wonder if the corporate structures are going to come back, because to hold a lot of investments, and also even for family trust, because it'll come back to your marginal rate outside the fund. I just don't know what you think about that.
Well, legislation hasn't come out for the minimum tax, withholding tax on distributions from a discretionary trust, such as a family trust, so we'll have to wait on that. But yeah, I mean, company structures will become more favourable relative to what they were previously as a result of these changes.
But not as a bucket company.
As a bucket company?
Yeah, where it was receiving the distribution from a trust, for example.
Well, they could still get caught up under this legislation. It's just to come through.
As opposed to what you're talking about is the company actually holding the investments and then deferring the payment out.
I mean, ultimately that's what the government's trying to push for, is it doesn't like this idea of a discretionary trust where you can choose where to distribute your income. They want everything to be unitised and the shareholders to be delineated, and so there's, or corporatised, so you're forced to have, a unit structure. So I think, yes, that's the intention of the legislation, and it's probably where things need to go. And yeah, the only kind of loophole is this franking credit loophole at the moment, whereas if the nature of the income you're receiving is fully franked distributions, you can essentially, earn that type of income at your marginal rate because of franking credits. But, who knows whether that will last to the next election.
Thank you.
Chris, Stuart, thank you very much.